What if becoming a millionaire didn't require winning the lottery, being born rich, or starting a massive tech company? What if the difference between where you are and a seven-figure net worth came down to a single, crisp $100 bill every day? It sounds simple, but the reality is that many Americans making six figures are still living paycheck to paycheck, struggling to stay afloat. A high income doesn't automatically create wealth, it just gives you more to work with. Building net worth comes down to a reality that most people overlook. It is entirely about what you keep, not just what you make. It is a matter of daily habits rather than relying on a stroke of incredible luck. Earning a high salary without saving is just operating a high-volume leak. To actually see your net worth grow, you have to find where the water is escaping and patch the holes. Those leaks are hiding in plain sight. They are the food delivery fees, the daily coffee runs, the random impulse buys, and the 5 different streaming subscriptions you haven't used in months. Take a second and think, what is one expense you could cut today that wouldn't actually change your day-to-day happiness? Let me know in the comments. This chart shows exactly how those small choices add up. A $20 a day habit stacks up over a single year to a staggering $7,300. Everyday impulse spending quietly drains your potential. As the saying goes, small leaks sink big ships. Let's look at the math of saving $100 per day. That is $700 a week, or roughly $3,000 a month. Over a full year, you have $36,500. You don't necessarily need a massive surplus in your budget to find that $100. Most people reach this number through a hybrid approach, cutting $50 of unnecessary spending and generating the other $50 through a side hustle. Once you have that $100 a day, you can apply the engine of compound interest. Think of it like a snowball rolling down a hill. As it rolls, it picks up more snow, growing larger and moving faster with zero extra effort from you. Your money starts earning its own money. Given the choice, would you rather work for money forever or have your money go out and work for you? This graph shows how that choice plays out over 30 years. The flat, straight line is what happens if you just keep that cash in a drawer. The exponential curve shooting upward is what happens when you invest it and let time take over. Look at the final decades on the right. The interest your money is generating far outweighs the actual $100 you are putting in each day. Compound interest rewards patience. It is the mechanical engine that converts time and discipline into a massive financial advantage. To get this growth, you need a specific destination for that $100. For many millionaires, that destination is an index fund, specifically one that tracks the S&P 500. This isn't about picking one single winning stock. Buying an S&P 500 index fund means you are buying a tiny slice of the 500 largest companies in the United States. You effectively own a piece of the entire American economy. Over the last century, the market has faced severe recessions, world wars, and global crises. Yet the long-term trend has historically moved upward, recovering and growing over the decades. This leads to the most important rule in investing. Time in the market beats timing the market. You don't need the luck to guess which single company will win next year. You only need the discipline to stay invested through the ups and downs. The math is straightforward, but behavior is where most people fail. They wait too long to start, they fall for get-rich-quick hype, or they increase spending every time they get a raise. Then there is the fear. When the market drops, instinct is to panic and sell to protect cash. But emotional selling during a frenzy breaks the compounding cycle. You lock in losses and miss the recovery. Let's be honest, which of these traps have you fallen into before? The reality is that steady, repetitive financial discipline will always outperform emotional, reactive decisions. Let's check the 3 core pillars. You need compound interest to grow money, index funds as your vehicle, and consistency to keep running. The path forward is simple. Start early, save consistently, avoid emotional decisions, and stay patient. Your future self is constructed by the choices you make today. Wealth isn't something that happens in 30 years. It's something you build every single morning. If this helped you, make sure to like, share, and subscribe to Exam Crackers. Remember, the best time to start was years ago. The second best time is today. Wealth is not a lucky event. It is built one day, $1, and one smart decision at a time.